Welcome, curious minds, to another deep dive.
Great to be here.
Today, we're plunging into something that, well, it really affects all of us. Doesn't matter where you are in the world.
Absolutely. Global economy stuff.
Exactly. Specifically, we're looking at the health of the global economy, but through the lens of European banks.
A very important lens right now.
We've got some fascinating, maybe a little concerning source material today. It's from the Eurodollar University.
Yes, their video. European banks are preparing for worst-case scenario.
That's the one. Here's what you must know. Now, you might think financial news is dense, impenetrable even.
It often can be, yeah.
But we're here to unpack it, find those core insights, and really make sense of what these huge financial institutions are actually worried about.
Right. Our mission really is to understand why they're being so defensive, why this particular stance now.
And what does this signal about the economy overall?
Precisely. And crucially, what it means for you, the listener, the consumer, and, well, the whole global economy.
It's not just abstract numbers, is it?
Not at all. It's about connecting those dots, linking the bank behavior to the real situations people and businesses are facing day to day.
So we'll dig into the ECB's latest bank lending survey.
Very revealing.
Dive into this bull steepening thing on bond curves, what that really means beyond the jargon.
Yeah, demystify that a bit.
And put Europe's economic temperature, let's say, in the context of these bigger global trends.
We want to give you that shortcut, to being informed, understanding the surprising facts, seeing that bigger picture.
Okay, let's unpack this. The first big takeaway, the real nugget from the source material, is this idea of risk-off behavior.
Yeah.
It's really growing among European banks.
Risk-off meaning playing it safe.
Exactly. On the surface, you see them piling into government bonds. That sounds pretty standard, right? A safe bet.
Classic stability move, you'd think so.
But it's the why. Why are they doing it? That's what's so telling, and frankly, a bit alarming.
It's not just a casual portfolio adjustment.
No. Their main worry, the thing driving this big shift, is the economic state of Europe's consumers. It's deteriorating.
So they're pulling back from lending to everyday people.
That's the core of it. They're tightening the purse strings, especially for individuals.
And what's really fascinating here, is why they say they're tightening. It's not the usual suspects.
Like tariffs or trade wars, things you hear about all the time.
Exactly. Those things exist. Banks are aware, sure. But that's not what's driving this specific, very pronounced shift in consumer lending.
So what is it then?
Well, the source makes it really clear. It's entirely down to these deep-seated fears about where Europe's own domestic labor market is heading.
Jobs and incomes?
Jobs, incomes, and just the general health of the European economy itself. This worry, apparently, it's so widespread, it's become, and this is a quote, entirely too common expression among banks all over the world.
Wow, all over the world.
Yeah. It signals this growing, almost obsessive focus on the fundamentals. Stable incomes, good job prospects.
The bedrock of any economy.
Right. Banks are basically looking ahead and thinking, we just don't see enough growth or stability out there to feel good about lending more to average households.
Because the risk of non-repayment is just too high, in their view.
Precisely. It's seen as just too risky right now.
So what does that mean for you listening, for us, the everyday person?
Well, even a small tightening in consumer loan standards, it's a huge warning sign, isn't it?
Like a canary in a coal mine.
Sort of, yeah. Or maybe like a doctor seeing a small but persistent fever. It tells you something's wrong systemically.
It suggests the information banks are getting, the data on potential borrowers, you, me, anyone applying for a credit card, a car loan.
Even just a small personal loan.
That information is deteriorating. They're seeing a future where people might genuinely struggle to pay back those loans.
Maybe because of job insecurity or wages just not keeping up with costs.
Or just less financial resilience overall.
Exactly. And this isn't just them tweaking interest rates slightly. It's a fundamental shift in how they view the risk attached to ordinary households.
They're basically saying the ground beneath people's feet looks, well, increasingly shaky.
And the ECB's own survey, the second quarter 2025 bank lending survey, it really laid this out in stark terms.
Let it show.
Banks across the euro area reported, a slight net tightening for mortgages, for house purchases. That kind of makes sense, right? Property markets, rates.
Sure, understandable.
But the report specifically noted a more pronounced net tightening for consumer credit and other lending to households.
More pronounced. How much more?
The numbers are quite telling. It was an 11% net percentage increase in tightening for both housing and consumer credit. So significant across the board, but really hitting consumers.
And why? What reason did the banks give?
They stated it very clearly. Changes in risk perceptions and the risk tolerance of banks.
So it's not regulations forcing them, not some external pressure.
Nope. It's an internal assessment. The banks themselves have decided the risk has gone up significantly, and their willingness to take that risk has plummeted.
They're becoming more risk-averse internally.
Deeply so. And looking ahead, this is the kicker, to the third quarter of 2025.
Yeah.
They expect to ease up slightly for housing loans. Maybe they see some stabilization there or expect rate cuts to help a bit.
Okay.
But they anticipate tightening even further for consumer credit.
Wow. Even more.
Even more, which just begs the question, why this persistent escalating caution specifically aimed at consumers?
It suggests a really grim outlook on household finances, doesn't it?
Absolutely. A worsening view of people's ability to keep their jobs, maintain their income. They are quite literally battening down the hatches for a storm in consumer finance.
And it's not just everywhere equally, right? The source mentioned specific countries.
That's right. It's concentrated, or at least reported most acutely, in Europe's powerhouses.
Yeah.
Germany and France.
The two biggest economies.
Exactly. Banks there are citing this factor the most, driven by a distinct lack of risk tolerance.
So if the economic engines are showing the most concern,
It sends a powerful message, doesn't it? These are the countries that usually anchor the continent financially when their big banks pull back hard on consumer lending.
it signals a major chill across the whole system.
The ripple effects are inevitable. It makes it harder for businesses, harder for individuals everywhere to get credit. It shows the financial heart of Europe becoming incredibly cautious, hashtag the forgot how to grow economy and labor market fears. And this leads us straight into a really key concept from the source material. This idea of the forgot how to grow economy.
Forgot how to grow. What does that mean exactly?
Well, Europe, like a lot of places actually, has spent the last few years with this painful lack of strong hiring, not necessarily mass firings everywhere.
Right, not huge unemployment spikes, except maybe Germany in pockets.
Exactly. Outside of certain areas, it's been less dramatic. But the situation for jobs, for joblessness, it's been more like, well, like the proverbial boiling frog.
Ah, the boiling frog analogy. Slowly heating up.
Precisely. You know the story. Throw a frog in boiling water, it jumps out. But put it in cool water and heat it slowly.
It doesn't notice until it's too late. It gets cooked.
That's the fear across the European financial world. This slow, steady, almost imperceptible deterioration in the labor market.
It's not a sudden shock, but a gradual erosion.
A gradual erosion of job prospects, income stability. And that makes banks incredibly nervous about lending, especially unsecured consumer loans.
So the economic temperature is rising, but not in a good way. Not hot like inflation.
No, rising as in things are just getting tougher for businesses, for individuals.
And interestingly, European banks are actually preparing for lower interest rates. That sounds counterintuitive.
It does, until you understand why. They see lower rates not as a stimulus for good times,
but as a consequence of bad time.
Exactly. Lower rates, in this context, just confirm expectations of low growth and low inflation. It's a sign of weakness.
So it's a shift from forgot how to grow to a situation where lower rates just underscore that the economy is worsening.
Precisely. It's not the central bank trying to jumpstart things. It's the market basically acknowledging the underlying weakness is so bad that rates have to be lower.
A sign of deep-seated economic malaise.
And while consumers, as we said, mostly avoided those big headline layoff numbers,
They've still been suffering under this forgot how to grow dynamic for years, haven't they?
absolutely, a persistent lack of new job opportunities, hiring freezes, wages not keeping pace.
So if you're a bank in that situation,
The last thing you want is more exposure to consumer loans. They're among the riskiest assets when the economy's shaky.
because they're unsecured, rely heavily on income.
Exactly. And the ECB report itself explicitly said, quote, perceived risks related to the economic outlook continue to contribute to a tightening of credit standards.
Direct link. Outlook worsens, lending tightens.
It's their unfiltered assessment of the financial health of their potential borrowers. And they clearly don't like what they see coming.
And the source was clear. This isn't primarily about geopolitics or trade wars.
Right, while banks are definitely monitoring sectors exposed to that stuff,
Sure, they have to.
it's not tariffs or trade disputes being cited as the main reason for this specific tightening posture towards consumers. It's pure economics.
Just years where the economy has failed to generate real growth.
And when an economy doesn't grow, the pie isn't getting bigger. For many, their slice is shrinking or staying flat while costs go up.
Which means the probability of those worst cases, job losses, spending cuts, just keeps rising.
It points to a deeper systemic issue, not just temporary external shocks. It's the landscape itself that's shifting.
And this shows up in the quality of existing loans too, right? NPLs.
Absolutely. Credit quality.
Yeah.
Euro area banks reported that non-performing loan ratios, NPLs, basically loans where people have stopped paying.
Bad debts.
Bad debts, exactly. Those ratios, along with other credit quality indicators, are having a net tightening impact across all loan categories,
So they're seeing more loans going bad.
which naturally forces them to be tougher on new lending. It's a feedback loop.
And they expect this trend to continue.
I do. Signaling a deteriorating economic situation where, as the source puts it, banks are essentially saying,
Sorry, your prospects just aren't good enough for us to lend to you.
pretty much, even if we wanted to, your credit score, job history, income prospects, they just don't meet our standards anymore because the overall risk is too high.
It's a cycle, isn't it? Economic decline leads to worse credit, leads to tighter lending, which strangles growth even more.
Potentially causing the economy to, well, forget even more how to grow. It's a stark picture of declining opportunity and rising vulnerability.
Okay, this is where it gets really interesting, maybe even a bit counterintuitive.
Mm.
Despite the ECB cutting interest rates, which you'd think would encourage borrowing.
Standard playbook, right? Lower rates, more borrowing, more activity.
Yeah, but overall demand for loans from firms, from businesses, it stayed really weak in Q2 2025.
Even with cheaper money available.
Exactly. It tells us businesses just weren't eager to borrow and expand. The source literally says it doesn't actually matter that rates were cut.
Wow. That really flies in the face of conventional wisdom, doesn't it?
It does, because if businesses don't see a reason to invest, maybe demand is weak, the outlook uncertain, then cheap money alone won't convince them.
It's like offering a thirsty person an empty glass. The offer isn't the problem, it's the lack of water.
Good analogy. So the cheap rates didn't really move the needle for business borrowing.
Well, the ECB survey did note that declining rates offered a slight theoretical boost, but global uncertainty and trade tensions dampened it. However, the core message, the overwhelming factor for banks, was those fundamental economic considerations.
That forgot how to grow thing again.
Exactly. They're looking at the lack of real growth and deciding, nope, not taking on more risk lending to the real economy right now.
So if they're not lending much there, where are they putting their money? They're not just sitting on it, are they?
No, definitely not. They're strategically redirecting it, and where it's going is very revealing.
But first, let's be clear. Banks haven't exactly been throwing money around for a while, have they?
Oh no, lending to the real economy has been incredibly weak ever since this forgot how to grow phase really kicked in around 2022.
There was that small pickup last year.
Mid-2023, yeah. But the source describes it as a rounding error, a tiny blip that barely registered against the bigger trend.
So lending is growing in absolute terms, but just barely.
Barely. So slowly that by any meaningful standard, especially compared to a healthy economy, it's effectively a contraction.
The European economy is falling further behind.
It indicates the money flowing into productive job-creating parts of the economy. The lifeblood of growth is just a trickle.
Let's get specific. What do the numbers actually show from their lending books?
Okay, so total loans across all categories increased by $27.2 billion in the first 5 months of 2025.
Sounds like a lot.
In isolation, maybe, but it's only a 1.4% increase. A healthy economy might see loan growth several times that, maybe high single digits.
Okay, 1.4% is pretty anemic.
Very. But now, where did even that small increase go? This is crucial.
Right.
Only a little over a third of it, just $84.4 billion, which is a tiny 0.7% increase, went to non-financial corporations like regular businesses and households.
The real economy.
The real economy, the part that actually makes things and employs people. And loans just to businesses, non-financial corporations, they increased by a truly meager 0.6%.
Less than 1%? Wow.
It screams extreme caution, bordering on paralysis when it comes to lending to the productive sectors. It's like a farmer deciding not to invest in new seeds because they don't think anything will grow.
So if only a tiny fraction went to businesses and people, where did the rest of that $27.2 billion and maybe other money go?
Well, the source shows a very telling redirection. Banks significantly increased lending to other loan categories,
Which in
notably some government borrowers. That category increased by $42 billion, or 3.8%, a much healthier growth rate.
Okay, lending to governments. What else?
And even more significantly, they poured money into investment funds. You know, what people sometimes call shadow banks.
Hedge funds, private equity, that sort of thing.
Those kinds of entities. Lending there rose by a massive $80.8 billion. That's a 5.7% rate of increase.
5.7% to investment funds versus 0.6% to businesses.
Exactly. A dramatic redirection of capital away from traditional productive growth avenues.
Towards things they see as safer, or maybe just less directly tied to the struggling consumer?
That seems to be the logic. This whole defensive shift, this strategic pivot, it's driven by that perceived lack of upside growth in the real economy.
Coupled with those rising fears about jobs breaking down.
Right. It's like,
Uh,
okay, here's another analogy. Imagine a cautious gardener.
Okay.
They used to confidently plant fruit trees and vegetables that's lending to the real economy, expecting a good harvest.
Makes sense.
But now, they're mostly just watering weeds and rocks, that's government bonds and these investment funds, because they're afraid the soil, the real economy, is getting too poor for actual growth.
So they prefer safer, maybe less productive assets, over taking a chance on real economic activity.
It seems so. They are taking some risk with those shadow firms, mind you, but they hope to keep it, quote, at arm's length. It signifies this deep aversion to the risks of a struggling real economy.
They're bracing for an economic winter, not planting for spring.
That captures it well, and the data on their own balance sheets backs this up emphatically.
How so?
First 4 months of this year, European banks went on what the source calls an epic bond buying spree. Government bonds.
Epic. How epic?
Their holdings of government bonds increased by a whopping $233.7 billion. That's a 13% jump in just the first 5 months of 2025 alone.
13% increase in gov bonds in 5 months.
Get this. They added more government bonds to their balance sheets than they extended in total loans to all categories combined.
That's incredible.
And look, longer term, since January 2024, when this risk aversion really started showing up starkly in the numbers,
Yeah.
their total bond holdings, up $450 billion. That's a 28% increase.
And loans to the real economy over that same period.
Only increased $227.9 billion, a paltry 1.9%.
28% increase in bonds versus less than 2% in real economy loans.
The disparity is glaring, isn't it? It just illustrates how deeply defensive they've become, prioritizing safety, liquidity, betting on governments over people or businesses, preparing their balance sheets for stagnation or worse. So with all this defensive shuffling, especially right across the European financial sector, it's really no surprise, is it, that interest rates are doing this bull steepening thing across European bond curves.
Right, the bond market reflecting the bank's actions.
Exactly. Now, bull steepening isn't unheard of, but it's often misunderstood. People tend to focus on long-term yields, right? Thinking rising long rates mean inflation fears or government debt worries.
Yeah, that's the usual narrative.
Sure. But the key, the source really hammers this home, is the short-term rates. The bond market, through this steepening, is telling us something very different and, frankly, much more concerning.
Okay, so break it down for us. Bull steepening. What does it actually mean in simple terms?
Simplest terms. Short-term interest rates are falling faster and further than long-term rates. The yield curve gets steeper because the front end drops more.
Okay, short rates down faster than long rates. Why is that significant?
It's a critical signal. It means the bond market sees serious economic weakness coming soon. That pushes those short-term yields down hard.
Why does weakness push short rates down?
Because the market anticipates that central banks will be forced to cut interest rates to try and prop up a faltering economy. The bond market is essentially front-running the central bank.
Okay. So the market predicts rate cuts because it sees trouble ahead.
Precisely. Think of it like this. You're planning a road trip. Suddenly, the gas price for tomorrow's drive plummets, but the price for a trip next year barely changes. What does that tell you? The market's betting on some immediate, significant issue, like an economic slowdown hitting right now, forcing prices, or in this case, short-term rates, down.
Got it. And the source mentioned Germany's rates.
Yeah, Germany's 2-year rate, very sensitive indicator. It actually hit its recent high the day before Silicon Valley Bank failed back in 2023.
Wow. Showing the market already sensed trouble even before the headline.
Absolutely. It shows how interconnected things are and how the market was already pricing in this defensive shift globally. And even after policymakers said, okay, banking crisis contained, all clear,
Yeah.
The German two-year rate didn't buy it. It stayed flat or kept trying to drop, signaling persistent fragility despite all the talk about inflation maybe sticking around.
It was like it was waiting for the other shoe to drop.
That's a good way to put it, reflecting an underlying weakness that hadn't been fixed.
So where is that German rate now?
Well, since about April 2025, it's been largely stable. But again, stability here isn't necessarily a sign of health.
It's more like pausing.
Exactly. The source suggests it's likely waiting for the next catalyst that will trigger the next step down in short-term interest rates.
So the market expects more weakness, more rate cuts.
That's what this behavior implies. It's not about investors suddenly hating German debt. It's a deeply defensive posture. The market expects economic contraction to force central banks to cut further, and it's positioning accordingly.
And this isn't new, is it? This trend has been building.
Been developing for a couple of years now. And critically, the source says it hasn't ended yet. The market continues to price in worsening conditions.
Not a temporary blip, but a deteriorating trajectory.
And the source uses a really powerful historical comparison to drive home just how serious this kind of bull steepening can be.
Oh, yeah? Which one?
2008, 2009, the global financial crisis.
Okay, the big one.
During that crisis, yields fell sharply everywhere, obviously, but crucially, short-term rates fell much farther and faster than long-term rates.
Just like now.
Yes. And then, from mid-December 2008 onwards, short rates kept plunging towards zero, hitting it by February 2009. Meanwhile, longer-term rates were kind of sideways, maybe even nudging higher.
Creating that really steep curve.
A dramatically steep curve. And this happened while the worst economic contraction was unfolding. Millions losing jobs, the economy hitting rock bottom.
So steepening, then, didn't signal recovery was imminent.
Quite the opposite.
Right.
That historical example shows that bull steepening at this stage means the market is focused on immediate, sustained weakness, driving short rates down, while the long end just signals prolonged low growth ahead.
A very long, painful period of economic struggle.
It's a clear and frankly chilling indicator from the bond market.
So underlying all this, the bank behavior, the bond market signals what's a core fear.
It boils down to this, according to the source. This insidious combination of a lack of upside growth, just no real prospect of things getting significantly better soon, combined with very real feels that the ROOP forgot how to grow economy will keep going and lead to further breakdown in employment.
That's the nightmare scenario for banks, isn't it? Stagnation turning into actual decline in jobs.
Exactly. That's why they're laser focused on consumer loans, why they keep tightening standards. They see this deterioration coming down the pipe right at them.
They're positioning not for growth, but to minimize losses when consumers inevitably struggle more.
Their actions are a direct reflection of their forecast. Prolonged economic difficulty ahead for the average person. Bronomic deterioration and the global silent depression.
Okay, let's zoom out even further. It's not just banks and bond markets sounding the alarm.
Right.
What about broader economic sentiment?
Yeah, the source points to the European Commission's own economic sentiment indicators, and they basically confirm this widespread worry.
How so?
Well, the main economic sentiment indicator for June, it only saw a tiny half-point pickup from December, went from 93.5 to a still pretty dismal 94.0.
Half a point. That's basically flatlining.
Exactly. This negligible improvement, this stagnation, it suggests businesses and consumers across Europe are just as nervous and pessimistic as the banks are.
A lack of confidence all around.
A deep, entrenched lack of confidence in the future. It mirrors the concerns we've been talking about.
What about employment specifically in those indicators?
Now that's even more telling, maybe even chilling. The Employment Expectations Index in June was 97.1.
Okay, 97.1. What does that mean in context?
Well, first, it's only 0.6 of a point above its recent cycle low of 96.5, so barely off the bottom.
Right.
But compare it to before the recent turmoil, November 2019, it was 105.2.
Wow, that's a big drop. 105 down to 97.
A significant, worrying drop in just a few years. But here's the really alarming part.
Go on.
Its current value, 97.1, is only about 10 points higher than the low point reached during the deep 2012 recession, which was 86.1.
So it's much closer to a serious recessionary state for jobs than it is to the healthy average of just a few years ago.
Precisely, and that makes it crystal clear why European banks are so worried about consumer loans. They see the job picture for ordinary people steadily getting worse.
And that's a direct threat to people's ability to repay debt.
Undeniable threat.
And this isn't just a European story, is it? The source connects it to global trends.
Absolutely. It aligns perfectly with what the World Bank reported last month, their very sobering projection
Which was?
that the 2020s are on track to be the worst decade in 60 years for global growth.
Worst in 60 years.
Wow. They project global growth slowing to just 2.3% in 2025. That's nearly half a percentage point lower than they thought just at the start of the year.
So downgrading expectations even further.
Constantly. This isn't just a blip. It's a fundamental, deep-rooted slowdown across the entire globe, affecting everyone.
Now, the World Bank often blames things like tariffs and trade wars.
Right. They do tend to point to those factors, but our source is emphatic. Those are secondary issues.
The real culprit is
The underlying pervasive economic deterioration itself, this forgot how to grow dynamic playing out globally.
and the numbers support this longer-term view.
Oh, absolutely. What's truly alarming is that average global growth in the first 7 years of this decade, the 2020s, will be the slowest of any decade since the 1960s.
Slower than the 70s, 80s, 90s, 2000s.
Lower than all of them. And it's not just a recent thing. Look at developing economies, supposedly the engines of future growth.
Yeah.
Their growth has been ratcheting down for 3 full decades. From 6% a year in the 2000s down to 5% in the 2010s, and now projected below 4% in the 2020s.
A steady decline over 30 years.
And global trade growth, same dismal story. Average 5% in the 2000s, now less than 3% in the 2020s. It paints this grim picture of persistent worsening trends over a very long time. It screams systemic problem.
It really sounds like something much deeper than just a rough patch or a normal cycle.
Yeah, more than a typical recession or a temporary shock.
The source suggests it might go back even further, to the end of the 2000s.
Exactly. It hints that something fundamental might have broken back then, maybe related to the 2008 crisis, creating economic circumstances that would, quote, continue to linger on like a depression.
A silent depression.
That's the term the source uses, lingering through the 2010s and now extending deep into the 2020s. Almost like the global economy has been walking with a serious, unaddressed injury for a decade and a half.
And we just kind of ignored it or misinterpreted the symptoms.
That seems to be the argument. The World Bank, European banks, U.S. banks, Chinese banks, they're all, in their own data and actions, picking up on this silent depression.
But wait, what about the early 2020s? All that talk of recovery, overheating economies, high inflation.
Ah, yes. The common misconception. The source argues that was widely misread.
How so?
Those accelerating consumer prices, the high inflation headlines, they didn't actually signal a hot, booming economy.
They signaled
They signaled that the supply of goods and services globally was badly constrained relative to a demand that was recovering, yes, but still fundamentally weak compared to pre-2008 trends.
So it wasn't a demand boom causing inflation, it was a supply crunch meeting weakish demand.
Precisely. People confused higher prices with a strong economy. But it was really a symptom of broken supply chains, geopolitical disruptions, energy shocks, and just not enough global production capacity catching up. A price shock, not a demand surge.
And the crucial point often missed. What was it?
Real demand, actual purchasing power, the desire and ability to buy stuff. It never truly recovered in a sustained, robust way after 2008.
It bounced back a bit.
Faster than supply could keep up, yes, which pushed prices higher. But the underlying demand remained weak by historical standards.
And the result of that weak demand plus the supply-driven price hikes.
Widespread global impoverishment. That's the stark term used.
Impoverishment.
Workers, ordinary people, mainly lost purchasing power. Their real wages got eroded by inflation, and they haven't been able to claw it back.
Why not?
Because, quite simply, there aren't enough new, well-paying jobs or strong income prospects globally. If overall demand for goods and services hasn't truly recovered.
Businesses don't need to hire more people or raise wages significantly.
Exactly. Why would they? It's a vicious cycle. Lack of opportunity leads to less buying power, which reduces the need for businesses to expand or hire, cementing this silent depression.
And as this impoverishment drags on,
Any little bits of employment growth we did see start to just disappear, like a mirage.
and the risk is it gets worse.
The risk is we transition from forgot how to grow, where things are just stagnant, into something worse, where we actually remember how to do worse.
Meaning active decline, contraction.
That's the implied fear. And that is what banks are expressly concerned about. It explains why they're clamping down, why they won't take extra risk unless absolutely forced to.
They see this multi-decade deterioration and the short-term signals like bond curves pointing downwards.
And they conclude the trajectory for jobs and incomes is likely to keep worsening. So their actions are purely defensive, bracing for more difficulty, not a rebound. Hashtag, tag, tag, outro.
So, wrapping this up, what does this all mean for you? For your finances, your view of the world?
Yeah, what's the bottom line here?
Well, today we took a really deep dive into these currents, pushing European banks towards preparing for a, quote, worst-case scenario.
And we saw it's not really about the headlines, tariffs, trade wars as the main drivers.
No, it's about fundamental, deep worries about jobs, incomes, and this idea of a global economy stuck in a silent depression for, well, over a decade now, according to the source.
And the actions of these banks, shifting dramatically away from lending to you, to consumers, to businesses.
And piling into safer government bonds instead.
Yeah. And the signals from the bond market, that bull steepening, it all points to this world where real robust growth is just incredibly hard to find, stubbornly elusive.
We've seen that pretty much everyone involved, banks, bond markets, employers struggling, consumers struggling.
They're all keenly aware, consciously or not, that there's just no upside perceived in the global economy right now. The risks feel entirely tilted to the downside.
And the idea that central banks can just cut rates and fix everything.
That seems like a non-starter from this perspective, doesn't it? The ECB's reserves, for example, they're just not translating into meaningful, real economy lending. The mechanism seems broken.
And the World Bank's grim forecast for the 2020s worst decade in 60 years for growth, it just aligns perfectly with what the banks are seeing and acting on.
It really does. It leads to that sobering final thought, doesn't it? What if the world doesn't just continue to forget how to grow,
but actually starts to remember how to do worse, adapting to a reality of ongoing stagnation, maybe even decline?
A powerful and frankly unsettling thought to mull over.
Definitely something worth thinking about as you watch the world unfold. We really hope this deep dive helped you connect some of those dots, understand these complex signals a bit better.
Hope it provided some clarity.
If you found this insightful, maybe learned something new, please do remember to follow, like, and share this deep dive. Help others get curious about these hidden economic currents.
Yeah, spread the knowledge.
And for more deep dives into these really vital topics, you can follow What Bitcoin Taught Me pretty much everywhere. Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.
Lots of places to connect.
Indeed. Until next time, keep digging for knowledge.